Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The U.S. House is passing the bill that would force a TikTok sale or face a ban. We want to get a little bit more on this with Daniel Flatley, Bloomberg national security reporter, joining us on this. Daniel, what happens now and kind of what is the victory here on a national security level?
Yeah, I mean, it's a great question. So, like you said, the House just voted a pretty big vote in terms of support for the sale or ban of TikTok. That was a vote of 352 in favor and 65 against. So that gives it some momentum heading into what might be a much murkier path forward in the Senate. We've talked to senators over the last couple of days, and basically they have some concerns, as senators are wont to do, about the speed with which this has passed the House and or moved through the House, and also, is this the right approach? Do we want to, target a specific company? So we don't know yet, and the Senate's out today, inconveniently, so we don't know exactly what the path forward will be in that chamber. But Biden has said that he would sign this if it passes Congress. So I think they're moving very quickly at the moment.
Can you made this interesting point that the future of this looks a little bit murky, but can you just remind us what's the national security risk that we're facing, such that we need to have this bill in order for it to be solved?
Yeah, no, it's a great question. So critics of TikTok, national security officials, including most prominently probably the FBI director, Christopher Wray, have long sort of warned about two primary vectors, if you will, of national security threats that could come from TikTok. One is data. The government of China several years ago now passed a law that says any company that was within the Chinese territory could be compelled to give data over to the Chinese government, if they ask for it. So that's one big problem. And then the other big problem is sort of, could TikTok be used in an influence campaign? Could it be used to spread propaganda? All sorts of things like that. Could it be married, potentially some of the data that's collected through TikTok with some other data that the Chinese government has gotten through hacks or other sort of cyber security actions and used to blackmail or bribe people? So it's all of that.
Yeah, that's the one that really makes me nervous. All right, Daniel Flatley, we appreciate it. We know you're quite busy, Bloomberg national security reporter, joining us. So the broader question then is, if TikTok is banned here in the U.S., what do you do with your ad dollars? Like, where do they wind up going? One person to go to on this, Seema Shah, Vice President of Research and Insights at Sensor Tower. She joins us now to discuss. Seema also used to work here, and she's really fabulous.
Thank you.
So I'm an advertiser. What do I do? Do I just go pile all that money into Instagram?
Well, okay, first, so the best way that we can go about thinking about this is thinking about what happened in India in June of 2020 when India banned TikTok. So essentially what we saw was huge gains for Instagram in particular in terms of active users, but also on an absolute basis for YouTube. And to step up, one step back, the reason is we've seen a huge growth in the popularity of short form video. Based on our data, users spend about 350 million hours per day on short form video versus 150 million for social media and less than 15 million for streaming. So it's the popularity of this short form video, and that's why you saw Instagram roll out Reels, right? So now about over 40% of people's time on Instagram is spent on the Reels portion. So when you're an advertiser, not only do you want to be on the app where people have the most engagement, but you also want to be on the right place on the app. So in Instagram's case, it would be in Reels. And so to think about, so that's how much time people spend on short form video. For TikTok in particular, globally, people spend 78 minutes per day on it compared to 48 for Instagram, and I think it's like 23, sub 30 for Snapchat. So Instagram has a highly engaged audience. It's become increasingly popular with advertisers because it has a younger audience, right? So we've seen ad dollars shift within the United States to TikTok. But Instagram remains popular. So I think that the short answer is you'll see gains in share for Instagram in terms of ad dollars, and probably YouTube. Maybe less so Facebook because Instagram still has a younger audience than Facebook. But I think that is the biggest repercussion. But for TikTok itself, the U.S. is 10% of their active users, 20% of their in-app revenue. And they've been growing their advertising business in the U.S. and probably globally. So on an absolute basis, this would be a blow to them and symbolic because if it happened in the U.S., it could be copied in Western Europe as well.
Yeah, I had absolutely no idea that the proportion of people watching short-form video versus social media was so skewed that way.
Yes.
But let me ask you a question from the point of view of an advertiser.
Yeah.
So this is all about, well, where are advertisers going to put their money?
Yeah.
But can you take a step back for me and give me a picture of how popular is social media short-form video spending versus other types of spending, billboards, whatever, magazine ads?
So our data focuses on digital advertising.
Just digital,
but
okay.
digital is growing because that's where a greater portion of people's attention is, and particularly within apps, right? Because time on apps, and you're kind of trapped. You're looking at the ad, right? So if they place it on your feed or in your reels, you don't really have a choice but to see it. And because apps like Instagram and TikTok know so much about the user, they can target their ads, right? So they can tell their advertisers, look, our audience is this, we're going to show your ad here where these people will see it. So I don't have the breakdown of digital versus traditional, but certainly digital is growing at a much, much faster rate, and particularly in the mobile space.
I mean, this is a very appealing business model with a lot of growth. So
yes.
Would it be easy for another company to buy TikTok then, based on all these users, all this ad revenue, and the growing platform?
Assuming they could just buy TikTok as is without any other changes, it would be a huge gain for somebody who's trying to grow in this space. Right. Because it's really hard now to grow users. Instagram is growing users. TikTok has seen a deceleration in the growth rate. It's still positive. And then apps like Snapchat are seeing growth internationally, but that's because they haven't been there before. But for the most part, similar to streaming, it's the apps are very saturated, right, in terms of downloads. So you have to think of what can you do to drive that engagement, right? And so Reels and then obviously TikTok have been able to get that attention and drive that engagement. So if you're somebody who wants to be in this space and you're not owned by a Chinese company, this would be a great opportunity for you to get into this.
Real quick, this is the trick question, or the billion-dollar question, rather. Who would be a potential buyer? Do you have any thoughts on that?
I've heard news of a lot of different companies buying it. I mean, I think it would depend also on a regulation. I mean, clearly one of the existing social media platforms may want to buy them. I don't think Meta platforms would be allowed to do so, but then you have someone like a Snap, or even smaller ones like Pinterest. If they were able to finance such a purchase, that would certainly push them way up in terms of active users engagement and understanding the audience even better, because they'd have that many more users to analyze.
Seema, it's so great to see you. Amazing
you.
analysis and stats. Seema Shah, Vice President of Research and Insights over at Sensor Tower, giving us the lay of the land on what's up next for TikTok. As the House does pass the bill to either ban it or spin it off, does it go to the Senate is really now the question.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The other breaking news we had in the last half hour is a judge in Georgia has dismissed some of the counts against former President Trump, trying to understand what that means, particularly how that sets him up going forward. Wendy Benjaminson is Washington senior editor, and she joins us now. Wendy, what does this mean?
Well, it is certainly good news for Donald Trump, and I'm sure he will crow about it and offer it up as proof that these are political persecutions. However, it leaves some of the more serious charges in place. The charges that were dismissed were the charges involving that quote-unquote one of his many perfect phone calls, so quote-unquote, to the Secretary of State of Georgia, the administrator of the elections, who heard Trump say to him, I just need you to find me 11,000 votes. So that the charge was interfering with an elected official or solicitation of, bad acts. So those charges were dismissed. However, there are still these RICO charges. Those are the racketeering and influence corrupt organization charges that prosecutor Fani Willis has charged Trump with, and those charges remain. So he is still in jeopardy of a felony conviction in the state of Georgia. However, this is the same judge who is deciding whether Fani Willis can remain as the prosecutor over these allegations of favoring a certain prosecutor that she was dating, the man whom she made special prosecutor. So that's still hanging over her head. The other reason this may not be as great news for Trump as he will undoubtedly post or talk about later today is that the judge said that Fani Willis was free to refile charges in a different way. So clearly there was some technicality we don't know about that led him to dismiss the charges. I'm sure we'll know more later.
Can you give us some sense of the timeline? Can you give us some sense of the timeline for all of these charges and court cases getting resolved, not just in Georgia but elsewhere?
Well, the hopes of some, particularly Democrats, that this would be resolved before the election are dimming. Now, there is supposed to be jury selection later this month in the New York case over his hush money payments to the porn star Stormy Daniels, whom he allegedly had an affair with. That's supposed to start later this month. Trump is trying to delay it by arguing that they need to wait till the Supreme Court rules on immunity. That may not be till June. So like I said, the chances of these trials all coming to fruition before the election are slim, but they may be in progress on Election Day, which would be just another unprecedented moment in this crazy election year.
Talk about unprecedented, it is now official. The U.S. House passes the bill that would force TikTok sale or potentially face a ban. We will talk about that in just a moment, sort of what advertisers do in that kind of situation. Again, the U.S. passes bill that would force TikTok sale or face a ban as 170 million people cry, particularly teenagers, cry with pain. I do want to get your understanding, Wendy, that what is now the smoking gun case that President Trump is up against, right? Like in all the polling, there is always that one thing. If he's convicted on that, I won't vote for him. Is there a that still?
No, actually there isn't. Our Bloomberg News Morning Consult poll shows that the country, at least swing state voters, who are the crucial voters we're waiting for, are evenly split on whether they would still vote for Trump if he were convicted on any of these charges. If you just ask the question, would you vote for him if he were a convicted felon, 53% said they would not. But when you divide the cases up into the hush money payments for a porn star or overthrowing the government, they feel the same way. They're not seeing these cases as one more important than the other.
All right, Wendy, we appreciate it. Thank you very much for jumping on with us. Wendy Benjaminson is Washington senior editor.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get Ben Emmons' take here. He's senior portfolio manager, head of fixed income at New Edge Wealth. He's standing by here. And also, if you are in the market, you read his notes. They are so great. They are so sweeping. They come at least 2 to 3 times a day. It's one of my go-to things to read, Ben. So I do want to say thank you for those notes. Do you have a Tesla? Do you have a Tesla or an EV?
I don't, Alix. And by the way, fantastic to be with you on the show. I think the last time you and I spoke was more than 5 years ago.
No, that can't be true.
Yeah, it's true. It was right before the pandemic. I was in the studio in New York with you. So great to be back with you. Yeah. So thank you, by the way, for the shout out on the notes. I don't have a Tesla. In fact, I have a Volvo. That's that's kind of my favorite for my wife and my. Yeah, that's like a European thing, right? It's like we're always stuck with that. It's kind of but a normal gas car. But to the EV discussion, I wrote about it not that long ago about these EV tariffs, right? As in, there's going to be, I think, part of that trade war story coming back, that the flood of EVs from out of China is so significant. I was just reading the BYD company, right? They're putting out a new car for $12,000 that you can buy. And this is why these EVs are flooding our markets. And I think you're going to get a lot of pushback from the US and Europe on trying to curb those cars coming into countries, because it's a major price competition to the likes of Tesla and others.
Well, can you talk a little bit more about that? Because we've got all the major automakers have their own EV plays, and then we've seen some of them pulling back. And so where is this all going to settle?
Yeah, I think it's going to settle at lower prices, I'm afraid, right? This is real price competition. And I think part of the reason why Tesla is losing its Magnificent Seven status, it had a very smart tactic, I think, about a year, 2 years ago, lowering prices and therefore juicing the sales. And now you're seeing the opposite sign of it, at least for now, right? They may have to cut more in prices to get higher sales, right? So it's the competition aspect, microeconomics, if you will, but I think this is what the EV market is ultimately about. It's going to be even lower prices, and for China, that doesn't matter, right? They like to continue to produce at even lower prices. So I expect more competition.
So Ben, let's broaden out for a second, because we've been talking about how the Nasdaq is selling off. I use that relative term, and you still have small caps holding up. Is this a rotation that we think, putting yesterday aside, this rotation from tech to small caps has legs?
I think it does have some legs, Alex, because it makes sense that if you have a specific group, semiconductors in this case, NVIDIA may be the star of it, but there's other related ones. If you think of Broadcom, of IBM, or any of those companies, that it expands itself out to other sectors. Now, I thought what was really interesting was the earnings from NVIDIA highlighting that their technology is now being used in healthcare, in financial services, in automotive. And I thought that was like, okay, this is actually Huang Jensen's view about these AI agents, right? They're spreading across the industries. And I think this is part of that broadening aspect of the market. Like, if that's true, the investment that the administration making in these semis in the economy, plus NVIDIA being such a powerful force on the economy in itself by spreading all this technology, then the other sectors are going to lift up too. At least the market will try to price it what it means for the economy, for other companies. Of course, in the end of the day, we do have to see AI truly pay off with sales, meaning you use AI and it can actually generate more sales in, say, in healthcare or financial sector, say, right? We haven't seen that yet, but I think the market wants to broaden out to discount that these sales will increase over time as AI is more widely adopted.
I wanted to, if we could shift gears just a little bit and think about yesterday's CPI print, because we've got this broadening out in the equity market, but there's also an enthusiasm there for the Fed to continue with its easing message. And so I wondered if you thought the CPI number yesterday should, give anyone some confidence that there's still cuts coming, or are you more of a mind that, hang on a minute, we might see fewer cuts than people are expecting?
Yeah, I'm more on that camp, fewer cuts. Because I think what the CPI data showed was that, one, the disinflation is stalling out. That's clearly now happening. Two, we're certainly not going to go back to where we came from pre-pandemic. There's too much pricing pressure building in the economy still. We've certainly not that the disinflation is going to flip over into deflation, even though I would note that Bloomberg Intelligence had a very nice graph out on how the number of categories with prices below zero has definitely increased. But if you look at the percentage, it was about 35% of the CPI index. That's not too significantly different from a few years ago, but it has somewhat increased. I guess, again, price competition probably in the economy. So I think the Fed is at that moment to say, this CPI data underscores that the economy stays above trend. And until the economy truly moves back to trend, right, just to trend, you cannot actually cut rates. I think that is, the big challenge for the Fed here, why they probably stay on hold for a little while.
Right. And first of all, if you shout out Bloomberg Intelligence, like, you're coming back all the time. Like, that's a definite +1 for Ben Emmons. But if that's the case, and I mentioned earlier that Jeffrey's starting to talk about that also, sort of following Torsten Slok over at Apollo, why buy small caps?
Yeah, I think you need to trade that differently, Alex. That, people, if you trade it too simplistically, like cut rates and then buy small caps, there's a lot in between there, right? One, the small cap index a lot of people look at that like, okay, there's about, I guess, 40% or so that are companies that are highly indebted, non-profitable companies. I guess they benefit from lower rates. But it's also just, I think, because of the economy in itself. I think small caps, I think of small business, I think of, what's all happening on the ground. So what was, I think, notable was what Bostic said, that they went out and did a survey among businesses, and those businesses said like, well, we think that if you cut rates, the economy is only going to get stronger, right? We're actually waiting for you to do that, and then we'll see even more activity. So it is partly true that I think cutting rates will benefit small caps, but there's also some micro aspects to it. So I wouldn't be all in. Our view, by the way, at New Edge is that, as Cameron probably talked to you about it, is that we're taking a very selective approach to small caps because, as you can tell, we haven't set a new record high in small caps, really because there are doubts about rate cuts. On the other hand, it's also about specific companies there. So it's a bit of a mixed bag, I think, and it probably will stay that way until we get a little bit more clarity on if the economy is going to keep trucking on the way we are doing right now.
What do you think is the biggest risk there for the economy to keep tracking the way that we're going now?
Well, one, it's that we are going to see a change in fiscal spending. If that actually happens, as in more cuts, right? Then I think the economy could slow. But this is clearly not a story for this year, as you can tell. We'll keep rolling the shutdowns like rolling blackouts, but it doesn't matter for the market because they know like nobody's going to put any type of significant cut into spending until there's a new president in the White House. And that's the big, I'd say, uncertainty from here. Whomever gets in there, my view on this is it's not political. It was more about, how much you're going to cut really,
right,
and still try to keep the economy on track, right? And that, I think, is a big uncertainty.
And it also feels like fiscal is going to come either way. Ben Emmons joins us, Senior Portfolio Manager, Head of Fixed Income at New Edge Wealth. You will definitely be coming back. It was really great to see you.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is going to be a segment that is near and dear to Jen Ryan's heart because you are looking to buy a home right now.
I am, and it is very, very painful, and I'm going to share that pain with you over the course of the rest of the week.
Yes, I love housing pain. I mean, not for you. I hate that for you, but I love it as a story.
Yeah, and it is just absolutely shocking. We're first-time buyers, and we are amazed at how disorganized and opaque this market is.
Oh, interesting. Is it the price? Is it the mortgage? Is it the supply? What's the hardest part?
It's all so hard. It's just hard to pick a favorite child here.
Oh, wow. Okay, well, this leads us perfectly into our next segment. So Lennar is reporting today after the closing bell. You're looking at adjusted earnings estimate of about $2.21 for the first quarter. You're looking at revenue estimates of about $7.42 billion. So nobody else better to talk to than Drew Redding, Bloomberg Intelligence U.S. home building analyst. Hey, Drew, is Jen going to feel better after Lennar reports? I mean, I appreciate that she's looking in Queens, but still.
Well, if she's looking for a new home, she'll probably fare a little bit better than something in the resale market. And it goes back to some of those things we've discussed in the past. There's not a whole lot of inventory in the resale market. And at the same time, builders have been able to buy down mortgage rates. So they're making the financing costs a lot more attractive for home shoppers, which are just not able to get in the resale market.
Yeah, I mean, talking about getting into the market, what's the incentive for me at this point? Because I feel like I'm sitting there, rates are still pretty high. There's not a lot of supply shuffling around. Like, where's my in?
Yeah, it's tough. And as I mentioned, in the resale market, things are particularly challenging. And we've been describing housing, for the better part of a year and a half as a tale of two markets. So you've got the resale market where costs are higher, inventory is lower, and you've got the new home market where builders have been able to expand their community counts, they're purchasing land, they're growing their inventory bases, and at the same time, they're making the financing costs a lot more attractive. So the competitive dynamics have favored the builders for the last year and a half, and we think that continues through 2024.
Has Lennar stock already run up enough that anything, is it sort of like the law of good numbers? Like, no way the stock's going to rally after earnings?
Yeah, good question. I mean, since the beginning of November, the builder stocks have been on a tear, along with much of the market. And I think it speaks to that competitive dynamic that have favored the builders. Intuitively, when mortgage rates are rising, interest rates are higher. That's not typically when you think about investing in the home builders, but I think that the dynamics have changed so much for them that there's been a lot more interest in the group. Now, if you look at where they're trading relative to book values over the last couple of months, they've certainly come back more in line with what you'd expect based on future returns on equity. It's interesting, though, if you look at some of the smaller and mid-cap builders, there's still a little bit of a disconnect between, expected earnings and what they're currently trading at. One of the things that I think is real interesting within the group is kind of, the drumbeat has started to get a little bit louder, and we've heard some CEOs come out and speak in favor of this, as you would expect, that builders have made a case that their stock should be graded higher.
What?
And
that's so weird.
There has there has been a precedent for this in the past in the case of MVR, and the argument is that the business models have changed so much. One, you've got businesses which are shifting to more asset light, so they're not holding as much land on their balance sheets. They're operating with historically low leverage, and they're becoming more systematic in their repurchase of shares because they're generating so much cash. So it does bear watching, as we get through this year and into next, if investors are willing to underwrite these changes in the business model as kind of a longer term thing.
Can you talk a little bit about how that willingness is going to intersect with changes in what the outlook is for Fed policy? Because after yesterday's CPI print, we're sort of wondering how many rate cuts we're going to get this year.
Yeah, it's a good question. And, a lot of the builder stock performance, and you look back to late October, early November, has been predicated upon what's happening with the Fed. When there was a lot of enthusiasm that the Fed was going to start cutting, maybe in 1Q, and there's going to be several cuts throughout the year, I think that's when you saw the stocks really start to take off. And I think what you need to see now from the builders in terms of an investment is, are lower rates going to actually show tangible benefits to the fundamentals? So one of the things that we're looking at specifically is gross margins. As we discussed, builders have been offering financing incentives, and that obviously comes out of their profitability. Mm-hmm. But I think a lot of the enthusiasm stems from the fact that with lower rates, builders don't have to be as aggressive in offering incentives. So I think there's a thought out there that margins should rise throughout the year. So that's what we're going to be looking at is, has this modest pullback in rates from 8 to somewhere around 7 right now enabled them to kind of dial back a little bit?
I mean, I got to say, this is totally anecdotal, but I am addicted to Zillow and I'm addicted to Street Easy. I love it for fun. I'm not looking to move. But I got to say, I'm noticing things getting snapped up in 32 days, 36 days, despite the fact that the 30-year is still pretty sticky. I'm but
those
amazed.
Are existing homes. It's is there enough available land for the builders out there?
Well, I mean, they're building up a ton in downtown Brooklyn. I mean, again, purely anecdotal, just talking about Brooklyn.
Well, buying up housing and tearing it down and putting up.
There's so many new complexes that are coming up. It's insane, and things are going. I mean, it feels. I actually really wonder if that 8%, 7%, 6% hurdle is as much of a hurdle as we thought, Drew.
Yeah, that's a great point. And I think so. We've been dealing with mortgage rates that are above 6% for more than a year and a half now. So I think as we start to get through this year, I think you have buyers coming into the market who are coming in with a better understanding of what their costs are going to be. Maybe they have to make an adjustment on the particular house they're buying. Maybe they're making a concession on the square footage of the home. But I think they have a better understanding of what their costs are going to be. And you have to remember, even though home sales are down significantly from 2021, we're still selling about 4 million single-family existing homes on an annualized basis. So there are still transactions, and as that continues, it starts to loosen up that mortgage rate lock-in effect, because you've had people who are buying at 6, 7, 8% rates who aren't going to be impacted by that in the next couple of years.
Going back to the search for among home builders for margins to rise, can you talk a little bit about what their cost pressures are like? Because what I really want to know is ultimately, how is this feeding into the inflation picture?
Yeah, so and speaking to Lennar specifically, they mentioned during their last quarter that their construction costs were down double digits from the prior year. So there has been a little bit of relief on the construction cost side. The expectation is that things will stabilize as we get through the remainder of the year. I think the one particular challenge for the builders that has become more of a concern is the cost of land. Builders bought up a lot of land during the pandemic. A lot of it was lower priced, And as we're doing higher volumes in the industry, builders are starting to cycle through that lower cost land. And now the stuff that they're delivering now and through 2024 and into next year is going to carry a higher cost land base. So there's going to kind of be a give and take between higher cost land and what they're able to do from a pricing perspective. What we've seen now, interestingly, is that builders have seen a little bit of pricing power on a like-for-like basis. So you will see average selling prices for many builders in the group start to come down. A lot of that has to do with where they're building or the type of product they're building. So there's been a shift to smaller square footage houses. But for that same square footage house, builders have been able to raise prices in many of their communities.
So, okay, so just to recap, we're watching concessions. We're watching house prices, right? Input costs and anything they say about higher cost land. Am I summing you up right?
Yeah, the other thing specifically for Lennar is they're going to be the first builder to report with the month of February when we did see rates move up from this called the 6.5% to 7% range. So we do want to see kind of the cadence of orders throughout the quarter and if that increase in rate did have an impact.
Real quick, we're just about wrapping up here, 30 seconds. Do you see any election year issues that we should know about for the home builders?
Well, you did have, which was interesting during the State of the Union, the administration came out and they kind of emphasized housing as a key concern and something that they wanted to focus on. I think you'll continue to see that kind of dialogue happening, but I think what they've discussed is kind of throwing money at it from the demand side, which we think ultimately ends up being inflationary. We think that in order from a policy perspective, you need to find a way to address housing from the supply side.
100%. That makes such good sense. More supply, prices come down, end of story, rather than make it easier to buy, in essence. Hey, great stuff. Really appreciate it, Drew. Thank you. Drew Redding, Bloomberg Intelligence, U.S. home building analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Here's an amazing big take story that we wanted to talk about. The title is How a Physics Whiz Made a Fortune Betting on Nature's Catastrophes. And you can access this story on the terminal on Bloomberg and also Bloomberg.com/bigtake. We do one every day, and it's a chance to go deep into the headlines here. Some of the underlying trends within the market. So let's go to the author now. Gautam Nick, Bloomberg Senior Editor, ESG Investing, joins us now. Gautam, walk us through what this article is. It basically feels like making money off of disasters.
Well, yes, on the face of it, I'd say that's probably what it is, but it's a bit more layered than that. So it has to do with insurance. So traditional insurance and reinsurance, do a fairly good job of covering modest and medium-sized catastrophes, storms and hurricanes and earthquakes. But every 30, 50, 100 years, you get a Hurricane Katrina-like event, which is completely devastating in its scope. And that's a kind of event that traditional insurance company can't really handle. So they've turned to a new type of asset class. Well, it's not new, it's been around for 25 years, but it's really coming into its own more and more now. And it's called catastrophe bonds. And the way it works is that instead of the insurance company taking the risk, should a disaster happen, that risk is passed on to Wall Street investors. So if the disaster does happen, the Wall Street investors can lose some or all of their money. So it's a pretty risky move. But if it doesn't happen, and these bonds are only, they run for only 3 to 5 years, not for much longer. If the disaster doesn't occur, then the investor gets to keep its original capital, plus gets a hefty return on top of that for taking that risk.
So your story, it's fascinating, and there's so much to dig into there, but you start off taking a look at Fermat Capital Management, and this is the owner of the world's biggest collection of catastrophe bonds. Can you talk a little bit about their strategy? And in particular, I just want to circle back to a comment that you made just now that in this current environment, this market is very, very interesting. And I wonder if you could talk about how a warming planet is figuring into Fermat's strategy.
Sure. So, there are always hurricanes and earthquakes, but the problem is that more and more people are moving to Florida and California and other parts of coastal regions in the world where, they want to have a nice view and a nice seaside experience, but those expensive homes they're building, when they get hit by a storm, they, tend to lose a lot of money. So that is the real problem, is that human beings are moving to these risky areas. And the insurance industries, either in some places like California and Florida, walking away from it. They're not going to insure people. The risks are too high. Or they're turning to kind of instruments like a catastrophe bond to do so. So Fermat Capital is the world's biggest cat bond investor. Their assets are about $10 billion. And they have a very interesting strategy. So like other cat bond investors, they do buy these risk models which help you to predict the likelihood of a hurricane occurring in a particular year or over 2-3 years. But what they do is they add a magic sauce, that because the co-founder of this firm, John So, has a physics background, he has a biophysics degree from Harvard. He's been able to layer an extra, sophistication in trying to predict the likelihood of risk and return for each of these potential catastrophes. So his buying approach is quite clever and sophisticated, and he hopes to get an edge from that. So that's where Fermat has really, they've been involved in this market almost since its inception, and they use this extra edge to try and beat the market and other cat bond investors.
And has it worked? What are the returns like?
Yeah, so the returns last year, which was a very good year for all investors, about 20%. And I think a lot of other investors also came in at that level. I should say that the interesting thing about cat bonds, it's a really good diversifier. So, unlike your regular, stocks or bonds that fluctuate with market movements or the Federal Reserve's decisions, a catastrophe bond's outcome is down to Mother Nature. Either she's kind or she's unkind. And if you diversify a portfolio with cat bonds, and you get the benefits of that, it's a really good diversifier that has no correlation with the rest of the financial markets.
Can you talk a little bit about how the current environment in the insurance market is affecting Fermat's returns? Because you make the point in the story that a lot of insurers are charging more to protect customers from devastating weather.
Well, last year was a record year for the issuance of catastrophe bonds. And this year is looking likely it's going to be, again, a pretty solid year. And that reflects the insurance industry's desperate need to pass on some of this risk beyond the traditional reinsurance industry to Wall Street. Wall Street is a huge, deep pocket with trillions of dollars at its disposal, a lot of, risk taking investors, unlike traditional insurance, which is a lot more conservative. So as you can see from just the number of new issuances that are lined up for 2024, that insurers are increasingly turning to this market. So one of the issues, a problem, is that secondary perils, as the industry likes to call it, so floods, wildfires, and thunderstorms are causing more and more insurance damage as opposed to, a Hurricane Ian or Hurricane Katrina-like event. And insurers are trying to figure out how can they protect their own portfolios, their own balance sheets, but also provide insurance to people. When you have more of these type of events occurring, this sort of medium-sized $5-10 billion disasters versus, the once in a 30-year event, and at the same time try to make sure that their balance sheet is protected. Mm-hmm. That's not so easy to do because we don't have much data on these kind of secondary perils, and also the models that are used that give an investor some certainty that they don't stand to lose. Typically a rare hurricane, the loss estimate is somewhere in the region of 2%. It's fairly low. The return you can get is something like 8-9%. Mm-hmm. So as long as that clarity isn't there for these tornadoes, thunderstorms, ice storms that you see in Texas, as long as that's happening, the insurance industry is going to find it difficult to access the cat bond market to cover those kind of perils, which are becoming more common.
Gautam, what are the main risk events that now a CEO is modeling that may or may not happen? Because he basically has to model what he thinks will happen and then either take a little bit more risk but for more reward or avoid that altogether. Well, what are the things that he's seeing right now?
Well, they own something like 250 or 280 individual catastrophe bonds, and the whole market maybe has 320 or so. These are rough figures. So they are very dominant. They own a vast swath of this whole market. That could include a tsunami cat bond for Japan, a typhoon cat bond for the Philippines, a hurricane cat bond for Mexico, all kinds of different events. So I think their modeling is primarily focused still on the big potential disasters, such as hurricanes or an earthquake in California or wildfires in California, and less so on things like thunderstorms, because again, they don't really have the data or the sophisticated models yet. But they're building up that, because that's where the catastrophe bond market is going to grow. It's going to move away from the kind of Hurricane Katrina-like events, the rarer big disaster events, and more to Hurricane Sandy-like event, which there is a cat bond for. The New York subway system has acquired 100 million cat bond. I think they've renewed it perhaps for the third time now to protect the subways from going underwater should a Hurricane Sandy-like event hit the city head on.
We have very little time left. Just in 30 seconds, can you tell us what's the next big move in catastrophe bonds?
Well, I think it's just going to grow. There's a lot more catastrophes are going to be covered. I think some of the secondary perils like flood and wildfires in particular, there's more sophisticated modeling available from certain modeling companies. Also, there's more data. And so I think that's where the cat bond market is going to grow, not towards the huge rare disasters, but more of the commoner medium-sized disasters.
All right, Gautam, thanks a lot. Thank you so much. Gautam Naik, he joins us, Bloomberg Senior Editor, ESG Investing. Again, a great big take, and you can check that on the terminal or at bloomberg.com/big take.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.